What happens if you invest £10 into the stock market every single week and do it for 20 years? That's the question I wanted to answer. So I went back in time, I got all of the data together, and I threw in £10 each week for more than 1,000 weeks. The results are pretty crazy, but what really surprised me wasn't the amount of money you end up with, it's how you end up getting there. Going back 20 years will make you feel really old. In 2005, the first ever video to be uploaded to YouTube was added, the first video iPod was released, and the US Office hit TV screens for the first time. I didn't want to like it, but I had to admit it was very good.
Angela dispute.
You already did me.
That's what she said.
Now, from a stock market perspective, things were also really interesting, and you're in this weird period of investing history. Just a few years before, you had the dot-com bubble, which was a time when the stock market went crazy and everyone wanted to buy internet companies. Now, since then, the stock market is still down around 20% from its all-time highs. So many investors are still very nervous about what's ahead. And to make things worse, we all know what will happen in just a few years' time: the global financial crash. So, what a great time to start investing. To be honest, this will make things a lot more interesting, I guess. So let's make our first investment now towards the end of 2005 and put in our first £10. To keep things really simple and fair, here's the rules that I'm following after I've jumped out of my time machine. I'm not going to pick any individual companies here or say that we got lucky and bought companies like Nvidia or Apple. I'm going to assume that we're able to buy a single global index fund. These were around back then, definitely not as popular as they are today, but you could have easily got access to them through popular investing companies like Vanguard. Basically, I want our money in this experiment to just track the global stock market. As companies grow bigger over time or even go bankrupt, I want our investment to just track those. So for example, as companies like Apple grow over that period, our investment in it will also grow too. I'll then say that every single week, no matter what, I'll put in £10 into my investment account and buy the exact same investment. I'll assume that my account allows me to actually put in £10 a week, but this isn't always the case with all investing companies. I'll also not worry about talking about fees or commissions. Let's just keep it really simple and just say that I've been given a free ride to be able to do this experiment. Now, let's see how we get on and fast forward a few years. Okay, so starting in 2005 isn't actually as bad as you might think. Although there are a lot of nerves in the stock market, generally, everything ends up going quite well. In fact, everything up until the global financial crash is pretty smooth sailing. If we look at the annual returns and how your investments are doing, you make a few percent in 2005, even with just a couple of months. Your account crosses the £100 barrier. So far, so good. In 2006, things were even better. The overall returns for the year were more than 20%, which is amazing. And before you know it, your investing account is heading for your first £1,000. Then another year passes and you've yet another really good year, making over 11%. Turns out that starting now wasn't so bad after all. And if it was me, I'd be telling all of my friends that they need to also get started investing too. Your account balance would be sat at around £1,300. However, just looking around the corner is one of the worst stock market crashes and economic events the world has ever seen.
About the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%.
In 2008, the financial markets came to a screeching halt. As you might already know, banks and investing institutions got caught up in a greed of lending money to people to buy houses. If you lived in the US and wanted to buy a $500K house, no problem. Don't worry about showing us any evidence of having a job. Here's your new house, here's the money, and let's just sell this mortgage to someone else and claim it's a good deal. What could go wrong, eh? After the end of 2007, the stock market fell more than 50%, and it took 18 months to get there, finally bottoming out in March 2009. This was a terrible time to be an investor, and only those with the strongest stomachs were there to buy up those shares, which we only now know in hindsight to be great deals. Now, for my time traveling experiment, we're still putting in £10 every single week, no matter what, even during this terrible period, as hard and painful as that seems. The question I want to know is, well, what happens to our money and how bad do things actually get? Well, to no surprise at all, our investing account goes from around £1,500 at its peak to below £1,000 at its worst point. Now, interestingly enough, that's a fall of 1/3, not quite the 50% that the stock market actually dropped by. So what's actually going on here? Well, there's two lessons here. Firstly, as we've already been investing for a couple of years by this point, our average price is actually well below that peak of the market. Well, secondly, as the market crashes, we also keep buying, which again pushes our average price further down. So when other people might have given up completely and sold out, or just stopped altogether, we keep going, and this means that we actually get to buy more investments basically at a discount. So the lessons here at this first major crash are the following. Now, one, there's no way at all to know if there is a market crash coming and when it will come. In this example, it's a few years into our investing journey and we get our first major crash. For all we know, this could have happened at the end of the 20 years, and in fact, this would have been a lot worse. So if anything, this should be seen as a bit of a blessing. Then secondly, this shows the power of being a consistent investor. If you invest regularly and often, it's called dollar cost averaging, or if you want to be really British about it, you can call it pound cost averaging. Now, basically, you get the average price of the market rather than trying to time it. It means that between the peak and the bottom of any market crash, your average price falls right about into the middle, helping soften the blow and potentially make more money later on. It's really interesting to see in this experiment, as lots of people like to talk about the extremes of a stock market crash and how much the market lost from the top to the bottom. However, the reality is that if you are a long-term investor and you invest regularly, then your actual loss is nowhere near those numbers. And continuing to buy, as painful as that might feel at the time, it keeps bringing your average price down. And this is just so important when we think about this for the longer term. Okay, so once we get out of the global financial crash, the next few years are actually pretty good for investors. In fact, 2009 is an amazing year just after the crash, where your returns end up being 32%. It's funny that often the best days in the market usually follow some of the worst. And this shows us just how important it is to stay the course and keep it long term. Now, over the next few years, our account really starts to grow and we end up making our first £10,000 by the time it gets to around 2017. In this time in history, iPhones are a lot more mainstream. There's not many people using the iPod. YouTube's become a huge platform with billions of views, and the US office has taken more than 30 awards, including Emmys and Golden Globes.
Ladies and gentlemen, if you would repeat after me. That's what she said.
Now, here's where things start to get really interesting, and our humble £10 a week really starts to go into overdrive. What we end up witnessing over the next few years is the power of compound interest. Now, all this money already invested is slowly snowballing, growing more and more each year, and the gains we've made also end up helping us make more gains. So check this out. Between 2017 and 2021, we turned £10,000 into £20,000. A nice double your money in 4 years. Now, it helps having a stock market which is pretty red hot, but at the end of the day, you have to be in it to win it. At this point, you're thanking your younger self for getting started and taking the first steps with that £10. Now, things aren't always going straight up and staying green. 2022 hits and it does cause your investments to go from around £20,000 to £17,000. After the initial COVID crash and subsequent boom of the stock market, inflation hit and central banks were forced to increase interest rates. Many people were then forced to tighten their belts and companies stopped hiring and investing. However, here's another year where you start to learn a really important lesson. Now, as a long-term investor, which you now are because you've been doing this for years, you know that in any given year, anything can happen. You also know that the price of the stock market is pretty irrelevant to you, as all you're focused on is building your wealth and trying to get a lot more in. You know that there are plenty of times where the stock market can drop and your investments can go into the red. However, you don't let that change your plan and you keep investing that money every single week, no matter what. In the long term, you hope to get rewarded, although, as usual, there is nothing guaranteed at all when it comes to investing. You just know that if you do nothing with your money at all, then it will lose its buying power due to inflation. So you decide that it's sensible to at least invest some of it. Here's another cool thing that happens in this 20-year period as well, again showing us the power of compound interest. By 2020, your account value is around £16,000. So this means that it's taken you 15 years to get to this point with your £10 a week. It's an epic achievement, and even if you could only invest for this long, and decide to sell it all, that's great. However, what happens over the next 5 years is amazing, as this £16,000 turns into £32,000. You gain the same amount in your investing account in 5 years as it initially took you 15 years to do. That's where the power of long-term investing really comes in, and the power of compounding. Those small sums of money that you put in many years ago have all become mighty amounts of cash that are working for you every single year. Tens of pounds turns into hundreds, and hundreds of pounds turns into thousands. Now, as a bit of fun, if you then left this investment and added no more money to it, in just over 8 years, you could double your money again. This assumes that you get the average rate of interest as you had in the last 20 years, which, if you're wondering, works out to be 8.8% per year. Now, where the next 20 years goes, I have no idea. And I've also got no idea where the next bad years are going to come as well. And the truth is that nobody knows what will happen next, even if they insist that something bad is about to happen and they're completely convinced. The truth is that any investing period could turn out to be really good or really bad. However, if you are able to keep investing over the very long term consistently, you put yourself in a great position to be able to get through any major crashes and corrections. The reality of most years in this experiment are pretty boring, to be honest. Every single week you invest your money, not really much changes. Sometimes it goes up and sometimes it goes down. In any single month of the year, your account probably won't change much. And in the early days, even if you got the best market ever, it's never going to be life-changing money. £100 going to £200 in a year is a huge gain, but it won't exactly buy you much. The real money takes years of doing it, and it takes years of dedication too. Also, as I already mentioned, there's no guarantees here either. So while it might sound easy to do, and I believe anyone could do it, just remember that it's way easier said than done. It's funny looking back and doing something like this, as it really does just sound easy to do, but obviously it's harder than it seems. Investing during really bad times seems completely insane when you put money into your investments and they keep dropping. It's only when things turn around and get better where you always wish you'd put more money in. Also, 20 years is really just an example for a long time period. The reality of investing is that it's something that we should be doing forever, and even if we are retired and taking money from our investments, we're still likely going to have the majority of our money invested in markets in some way. Investing doesn't just have an end date where we're forced to live with what we have. And finally, if we want to increase our investments and put more than this humble £10 in, then we can do whatever we want. Now, the truth is, in this video, I've left out loads of details, and I'm sure you've got a ton of questions, especially if you want to get started investing. You might be wondering, well, what platforms do I use? What should you invest in? Or even, what kind of account do you need to open? Now, luckily for you, I've made plenty of videos to help you get started. If you want to start from the beginning, I'd recommend watching my How to Invest for Beginners video here. For another video that's been extremely popular, if you already know some of those basics, try this one here where I explain how I'd start investing all over again if I had to start today. I'll see you over there. Happy investing.